Good morning, everybody, and welcome to the Daily Energy Markets podcast. It is 10:30 a.m. in the United Arab Emirates, and we have Brent crude oil trading a little higher this morning, up about 0.5%, at $73.12. Slowly but surely, that climb continues. It's sort of base camp one or two, I'm not sure. Base camp one will go for in the climb to $80. Let's kick off this morning with Paul Horsnell, Head of Commodities Research at Standard Chartered Bank. Paul, your thoughts? My sense is today, Tuesday, that the gathering in Singapore last week of the great and the good of the energy markets world had talked themselves into a bear cave and pushed that price down. Everybody in the echo chamber, oh my God, the world's going to end. And they kind of did it to themselves. And now that that's behind us, normality returns. Your thoughts?
Yeah, morning, Phil. I think you put it very well. That was a very dark and damp cave they all wandered into, and then everyone got even more miserable as they spoke to each other. It was not a happy occasion. I think IP Week in London is much happier. There's more joy, but no, there was no joy about. I think it was partly just because of market dynamics. I mean, this is the kind of market where I think us fundamental analysts have to take a step back and say, hey, look, this has nothing to do with us. I mean, until things settle down, until positioning has sorted itself out, until some of these other effects, the momentum, the algorithms, the very strong gamma effects, which banks covering from on their option positions, options they've sold to producers, really we can't really determine what's happening day by day, week by week. And in your sort of first stage, the first camp, I think it's getting to that kind of position, getting to somewhere where fundamentals start to matter more on the day-to-day and on the margin. So yes, miserable, but I think we are getting back towards the hope of cleaner positioning. Funds, CTAs are as short as they've ever been. They're roughly on equivalent with the positions from 2008. I mean, this is not the global financial crisis. I mean, we may be worried a little bit about a slowdown here and a slowdown there. It's not the global financial crisis. So for positioning to be roughly equivalent to the global financial crisis, when obviously prices were higher then, just seems a massive overshoot. It's the wrong price. Everybody knows it's the wrong price. We're really sort of having a dispute on, well, once it's clean, once the positioning sorted itself out, once the algorithms have settled down, and once some of the madness has gone away, and we also what we got through in the first set of Fed cuts, what's the kind of reasonable level to end at? And I think it's above 80. Others might think it's between 70 and 80. But I haven't found anybody with commitment and actual numbers saying this is a cliff edge and we're looking at 40s and 50s. The Spider-Man numbers are pretty good. We got a deficit in September already. That's been added to by the outages in Libya. Libya does look like it's going to drag on for a little while from here. Some loss of supply in the US Gulf. It results in a September deficit of somewhere between 1.5 and 2 million barrels a day. I've got deficits in the numbers right the way through to the end of the year. So has the US Energy Information Administration. And this does not feel like bad fundamentals. If anything, I think the market's just got it so wrong. And we're probably going to, the bears will emerge from that cave and they will perhaps relent at their leisure as the numbers improve over the next couple of months.
Victor Yang, senior analyst at JLC Network Technology in China. Victor, is it all your fault? There's one reason of maybe a few that I really disappointed I didn't get to Singapore last week, and that was to get to your presentation. How wrong are the markets getting China, or is China as bad as the narrative indicates from a demand point of view?
Well, when we were in Singapore back in April, people were overly optimistic and they forecast growth of at least over 500 kbd in the country's crude imports, and some forecasts made it close to 1 million barrels per day. Well, when we forecast just 120 kbd of growth in the country's imports back in April, we were questioned by some clients, some people. And now it seems that we were a bit optimistic already when we forecast a modest growth in 2024. Because now, and when we were now back in Singapore last week and 2 weeks ago, and people were on the whole very bearish as China didn't live up to the expectation. And now they expect it's just the opposite. Early this year, they were very optimistic when China set the GDP growth at about 5%, the same as last year. And now they turn very bearish. So it's just like two opposite. Yeah. And I can understand because of the expectation and the reality well. But now we do not see as bearish as they see at the moment. I mean, for 2024, we do expect a slight drop in the country's crude demand, judging from its crude imports, its throughput, its refining margins for independence, and so on. We do not expect growth for 2024, but we expect things to improve gradually after 2024. Yes, that's basically it. Yes.
Let's welcome Bill Spindle, Senior Global Correspondent, Cipher News, our roving election go-get-'em guy. Bill, I mean, how bad is China? How good is the United States? I don't know if that's the counter narrative, but it seems we have some clarity. China maybe overbearing the bear there, but still not as good as one hopes. But the US is the one to me that I find a bit foggier. We're about on the doorstep of a 50 basis point cut in interest rates. That usually tells you alarm bells. This economy is going off a cliff. Your thoughts on the outlook? How should we be reading the data, the macro data of the U.S. economy?
Yeah, I think this what you call it counter narrative is about right. I think in the U.S. we are looking at this tenuous decision between a 50 basis point and a 25 basis point cut. People were pretty optimistic before because you saw inflation falling and the labor market not looking all that weak. But I think, there are ways to look at it that inflation still is up around 2.5%, not really at the Fed's target quite yet. And you're starting to see some real signs of weakness and softness in the labor market. So we may see that 50 basis point cut, but I think that would also send a signal that's a little more alarmist than the Fed maybe wants to send. So it'll be interesting to see where they come out on it today. But I do think the risks feel a little more on the downside in the U.S. As opposed to, as Victor was saying, in China, where I wouldn't say the risks are on the upside, but it's sort of expectations game, right? It might not be quite as bad as it looks in China, where it may be slightly worse in the U.S. Than the optimists think.
Paul, your thoughts on that? I mean, where the U.S. goes, if they go 25 or 50 basis points, does it matter for the immediate direction of the energy markets? What are your thoughts on that decision? Of course, a seismic shift from having been a tightening market for 2+ years. Now we're starting an easing one.
Oh.
You're on mute, Paul. Sorry.
Not any longer. Here I am.
No, there you go.
Very much agree with Bill. I think our strategists are very much in the 25 basis point cut camp, and they think it's easy to make a mistake on 30 as on 25, that the data doesn't justify a 50 cut at this point. And very much as Bill said, if anything, if you start off with a 50, that looks is more likely to alarm. It implies the Fed's got some data that there is a cliff edge the rest of us can't see. Whereas cutting 50 and inflation doesn't really calm down till the first quarter of next year, and the next labour market print turns out to be strong. It looks, question, why are you cutting? I mean, why by that much? Why did you go 50? So should we say the policy of least regret is going to be 25 rather than 50, we think. But clearly, as Bill's enunciated, it's a fairly still seems a fairly knife-edge decision, certainly as far as the markets are concerned. I think from all market point of view, this is just something we want in the rearview mirror. I mean, it's been dominating market discussions for how many months? 3-4 months we've been talking about when's the next, when's the cycle turn, when does the Fed cut? A lot of the macro discussions are based purely on that. And a lot of the positioning in the oil market has been about rates, it's been about Fed, this correlation between the 10-year Treasury and the oil price, meaning a lot of rates traders are actually putting some of their rates positions, expressing those through the oil price. So I think getting that noise out of the market, getting the turning of the cycle behind us would be constructive in that it's perhaps returns the focus a little bit more to oil market considerations. But I think we just need it done, whether it's 25 or 50. I don't think ultimately it's going to make a huge difference as long as the market overall doesn't take it as a signal of distress, or as Bill said, something that might alarm the market. But certainly it would be constructive, I think, for all just to get this in the rearview mirror and perhaps even get the next FOMC meeting in the rear mirror as well, because now the discussion is going to go into how much are we going to cut through to the end of the year. Will it be 50? Will it be 75? So it continues, but at least starting the process, I think, does help.
Some sort of dotted plot, as they call it, would give the market some clarity or some alignment. Victor, I wanted to get your I mean, again, in this sort of uncertain outlook for China, to understand some of the factors that have been reported. Chinese refinery run rates down by 10% in August, on the month in August. And we've seen over the period of the summer, big build in crude oil stocks in China. How should one interpret that? Is that weakness or is that appetite for oil at good prices?
Well, for now, Chinese refiners runs are low. For SOEs, I mean state-owned refiners, their run rate has not dropped much, but independents have dropped quite dramatically this year because of poor margins. And for August, demand, actually for August, demand for gasoline and jet fuel should be seasonally strong, but diesel demand was weak. And for the whole of 2024, diesel demand is one big drag on the country's crude demand. And one of the major reasons is the shrinking industry of the real estate industry, And another one is the price of LNG compared with diesel, much lower, and attractive fast use of LNG power trucks. So these are the two major reasons for a plunge in China's diesel demand in 2024. And that's one of the major reasons for the decline in China's crude runs. But when it comes to crude stockpiling,
do you expect to yep.
Yeah, when it comes to stockpiling of crude, and it's not what I read from overseas is not accurate, because they tend to use domestic production plus imports, and yes, production minus imports minus, well, throughput, and that's not accurate because there is a lot of consumption in the industry sector and some other sectors. Say for example, in 2022, the industry sector consumed about 5 million, if my memory serves me well, about 5 million metric tons of crude a year. And there's still some consumption in some other sectors. So it's not accurate to work out the country stockpiling this way with the consumption, refinery crude runs, and imports. That's not the way to work it out, yes.
Would we be seeing, Victor, just as a follow-up there, obviously at the beginning of the year, the Chinese government set the target of 5% growth in 2024. Is that still realistic? Should we be adjusting that? Is it being adjusted downward, or what do you think? Is that target still in the reality?
Well, in the 6 months of this year, only 16 provinces and regions achieved growth of 5% and above, which means half of the provinces and regions did not achieve the growth of 5%, and some were far below 5%. So they're actually under more pressure to achieve this goal of 5% growth for the whole year of 2024. But I do not think the Chinese government will address this target for 2024. It will still try to achieve this target. And for the last few months of the year, we mainly focus on the boost from the large-scale equipment upgrade and the subsidies on tradings of consumer goods such as home appliances and cars. The government has earmarked about 300 billion yuan for the subsidies on car tradings and home appliances tradings and so on. And these subsidies will be available until the end of December this year. So this now is not giving a boost to the sales of cars and some home appliances and so on. So we can still see some stimuli for the remaining months of 2024.
Bill, I mean, half joking at the beginning there, but where is the US election now at this point? Is there anything to tilt it away from other than just going to be another very, very close election, despite all these noise? Everybody wants to shoot Mr. Trump, and Miss Harris is a new, very bright new light. But ultimately, at the end of the day, this is a nail biter. A few votes here and there in the swing states, despite all the noise. Your thoughts from being on the ground there? How does this feel? How's it transpiring?
I think that's exactly what's transpiring. You've got lots and lots of Sturm und Drang on the surface, a very volatile situation, which I suppose could break out in one direction or another, but it just seems very unlikely. You know, very few voters are up for grabs in terms of really being a real swing voter who could go potentially either way. Mostly they're just trying to turn out their bases. And it's going to come down, as you say, swing states. There's about 7 of them. They're very close. I suppose if you had to handicap it in this very moment, maybe Harris is an itty bitty bit ahead, but that itty bitty bit kind of shifts back and forth, and that's, I think, where we're going to be right up to election day. And voting has already started, so it really is now in the process of being decided.
And in your space that you obviously track quite closely, obviously the energy transition, do you see either candidate? Obviously, on the surface, again, it seems that Biden Democrats have been a bit more receptive to the transition. They passed the IRA Act and so forth. Would Trump reverse that? What's your sense of the difference it would make from that point of view, energy transition, to sustain through to the next administration?
Yeah, I think in terms of things like oil production and that, in the short and medium term, there's really no difference in practical effect. The Biden people talk obviously more about energy transition. They're less gung-ho about drill, baby, drill, as Trump likes to put it. But the Biden folks and Harris also have done absolutely nothing to get in the way of more oil production. It's really in the longer term that you're going to see the difference. Are we going to see an energy transition that proceeds? Under Trump, I think it would be a much more organic kind of, I hesitate to say market-based exactly, but it would proceed more slowly in a kind of more organic way to the long term, where there would be big differences. Whereas under Biden, current policies and Harris's future policies, I think you would see a much more deliberate effort to push an energy transition forward, which would obviously make significant difference over the longer term. But I think we're talking late 2020, 2030s, things like, long-term LNG production is sort of up for grabs, even as short-term production is certainly going up, and neither side's doing a whole lot to do anything to get in the way of that. So it's over the long term, but there are differences there for sure.
Let's go to the survey question, which is looking at the point of China. This was the data point I came across today, which took my attention, trying to understand to the extent of, have we kind of bottomed out in China? So half of the provinces, as Victor said, haven't met their target 5% growth. Some, as Victor said, are way short. But this data point, which is sort of a significant, profits for major catering businesses in Beijing plunged 88% over the first half of 2024. And when I read that, I dug deeper into the whole area of agricultural products, and Chinese imports of their normal scale of agri-goods, whether it be soya or corn or wheat, are just, I mean, oil might be falling off a cliff, but grains and wheat are all falling off a cliff, with 50% down and 80% down on year-ago levels. I mean, when you look into the ags, they tell you that China has definitely got a floor that maybe we haven't hit yet in oil. At least they've hit it in ags, and I'm not sure what that tells us, but ultimately I thought it was worth noting. So my question is, has China's weaker economic performance now bottomed out in whatever we've seen this year, this post-COVID period of malaise, the real estate problem that keeps sort of popping up but not being a kind of Armageddon moment? But so has China's weaker economic performance now bottomed out? Yes, it has. We've got recovery from here, or no, deeper weakness ahead. So that's kind of something to think about. Paul, if you're OPEC Plus, sort of answering that same question, which inevitably they have to try and do, whatever happens in the US, where do you think OPEC Plus go with this? They made their choice 2 weeks ago to postpone the increases, but only by 2 months. Your outlook for the kind of decision OPEC Plus has to make, and the supply-demand opportunity that they face?
Yeah, and obviously it will depend a little bit on a lot on the numbers for next year. I mean, just to tail on to saying there on China, the Standard Chartered GDP forecasts for China are for a continued gentle, shall we say, slowdown. I mean, after 4.8% growth this year, we're forecasting 4.5% for 2025, and then 4.3% for 2026. So again, not a long way from, these are rolling gentle hills. These are not cliff edges. We're not looking for discontinuities. And I think within the OPEC Plus plan, again, is not a discontinuity in terms of China demand. It's a gradual slowing. Demand elsewhere in the world is actually pretty good. I mean, it's certainly coming out above par in most regions. So let's look for next year's demand growth of, we think 1.3. I mean, some are a lot higher than that, some are a bit lower, but roughly normal compared to sort of pre-COVID standards. And non-OPEC supply, growing, but again, no discontinuities. I mean, I still see in the press every single day that the wire services talk about, there's a glut, there's this surge of supply. US supply has surged this year. No, it hasn't. I mean, there's 1 million barrels a day less growth out of total US supply this year than there was last year. We think it's going to be able to just sort of maintain some growth into next year, but it's not a surge. Guyana's growing, but there are lots of places falling. Overall, it's sort of so-so. It seems broadly balanced. I think the plan is just they will look at the numbers, look at the bounces. That's a lot of moving parts. They have the opportunity to pause at various points along the way, depending on market circumstances. This looks very much under control, very much controllable. I would be surprised if we didn't get another pause at some point through next year. That's just because the way markets move around, the way data also moves through on cycles. But I don't think there's a problem for OPEC Plus. I think this narrative which came out of your caves in Singapore of, oh, it's a crisis, they've got no bullets left, there's nothing they can do, there's a glut, demand is coming up a bit. It's nonsense. It's just not there in the data. I mean, it's somebody's dream of what might happen or somebody's nightmare, but we just don't have a shred of actual data that suggests that there is any major concerns there. All looks perfectly controllable. If OPEC Plus could turn around markets and sort out balances after COVID, there's nothing here that looks at all frightening compared to the post-COVID instance. And I think we always have to give them the credit for having stabilized markets over the past couple of years, and particularly in 2021. And that doesn't imply to me an organization that's going to struggle with, a gentle slowdown in China, a little bit of growth, supply growth here and a little less growth elsewhere. This is all very much within bounds and nothing that's sort of leaping out unexpected around the corner.
Victor, on that point, and just, there's been another part of the China narrative this year is that, the Chinese government will finally come out with that bazooka stimulus, and we get little bits here and there, interest rate management, bank deposits and so forth. Is there still a frame in which the government could initiate a very generous stimulus that could have impact here? Or what do you see that role going forward, the necessity or not for it?
Well, in the first few months, we saw some stimuli, but not very strong ones, such as for the real estate industry, cutting the down payment and rate. And for the second half of the year, for the last few months, we just expect two major stimuli. One is the large-scale upgrade of equipment. Another one is the subsidies on the trend in the consumer goods and cars, trucks, and so on. And now this is giving a boost to the last few months of growth in the 2024 and 2024. So we do not see it to worse in the last few months, 2024. So mainly these two stimuli will help the economy to recover slightly in the remaining months of 2024. But it's difficult. I mean, the stimuli, the subsidies will be effective until the end of December. So we do not expect this to be long-lived, it's just short-lived. And we still need strong stimuli for the coming years, for next year, for instance. Otherwise, the country is still under great pressure to achieve this growth target of 5%.
On the flip side of that, Victor, is there, as we said, that whether or not big stimulus will come, it looks uncertain. It hasn't happened yet. But on the other side of that, are we still at risk of something still major happening to the Chinese economy on the downside? Like, is the real estate issue, for example, still a potential, implosion of sorts, or is that a managed deflation? How big is there anything big there that we should be aware of that could be the surprise, particularly the real estate issue?
Well, in 2024, the real estate industry was still shrinking. Say the investment in this industry dropped by 10.2%, and the area of new construction in 2024 plunged by over 12%. And in some months, the drop was over 20% on a year-on-year comparison. So the real estate industry was still a big drag on the country's economy in 2024. We do not expect the industry to improve yet in the coming 2 years. And hopefully after 2027, we can see some improvement or some rebounds for the real estate industry. And when the real estate industry stops being a drag on this economy, the government will be under less pressure to achieve its targets. Yes.
Yes. Bill, last word for you. I wanted to take the opportunity, although you're sitting in the US today, you are one of the world's best analysts on India. And I wanted to get your thoughts a few months into Modi's re-election, but now without winning a majority. What does that feel like to you? What does it mean for, do you think, the outlook for India and its continued boom growth?
I think it's amidst a lot of rocking of the ship. I think it'll continue to grow pretty impressively, but never quite getting to the levels that many people really hope as quickly as they would hope. I don't, their manufacturing successes, getting supply chains to move there, have been somewhat successful, but they're still really struggling to build the full sort of ecosystem of suppliers that you see in a place like China, or even some places like, Southeast Asia. So, I think it'll continue to be a struggle. If I just add one real quick thing on China, I think the Japan experience post 2000 is really what we're going to see. You're not going to see necessarily a real fall off the cliff, but constant disappointments on the upside, constant false starts. It's that demographic decline overlaid on a financial crisis with this eroding force of deflation constantly pulling at the upside.
And the layer, I suppose, of quasi-sanctions, quasi-customs and pressure, trade war-y type pressure. Answer on this room is, has China's weaker economic performance now bottomed out? Yes, no. Bigger no than yes. Here, we'll post on social and see if that is agreed to. Paul Horsdale, thank you so much. Great to have your insights today from the UK, all the way over in the US, Bill Spindle, and all the way the other direction in China, Victor Yang. There's nothing like going all around the world in 30 minutes. The only place you can do it, of course, is the Daily Energy Market podcast. Maybe occasionally CNN get it, but other than that, it's right here. Thanks, guys. Catch you all soon again. All the best.
Thank you.
Okay.